Hello everyone. Today we welcome to my next video. Have a great day watching this video. Why do crises make the rich richer? There's a recurring paradox in economic history. Every time the world enters a crisis, the poor worry about survival, while the rich prepare to expand. Not because they are insensitive, but because they are in a different position within the system. A crisis is not just a market collapse. It's a test of the financial power structure. And when the system is threatened, it will do everything to save itself. 1. The system's only question. When a crisis occurs, the system doesn't ask, how can we make everyone fairer? It only asks, how can we avoid collapse? In 2008, when the US housing bubble burst, major banks like Lehman Brothers collapsed. Financial markets froze. Confidence vanished. The US government and the Federal Reserve responded with a massive bailout program, injecting liquidity, lowering interest rates to near zero, and beginning a new era, quantitative easing. Money was created on an unprecedented scale. In 2020, when the COVID-19 pandemic spread worldwide, the scenario repeated itself. The market collapsed in just a few weeks. The S&P 500 index lost more than 30%. And then, the Federal Reserve opened the money tap again. This time, on an even larger scale than in 2008. 2. New money doesn't fall from the sky. We often picture printing money like rain. But money doesn't fall from the sky onto every rooftop. It goes through the banking system. It flows into the bond market. It injects liquidity into the stock market. In 2009, just 1 year after the 2008 crisis, the US stock market began its longest bull cycle in history. After the March 2020 crash, the market didn't take many years to recover. Just a few months later, technology stocks reached new highs. Companies like Apple Incorporated, Amazon, and Tesla surged in value. Financial assets swelled, but average wages didn't increase at that rate. 3. The Cantillon effect, a little-talked truth. There's a concept in economics called the Cantillon effect. It states that those who receive new money first will benefit the most. Those who receive it last will suffer the devaluation. Who receives the money first? Banks, investment funds, large corporations, capital markets. Who receives the money last? Workers. By the time the money reaches them, asset prices have risen. House prices have risen. The cost of living has risen. The gap doesn't appear because of a conspiracy. It appears because of the order of distribution. 4. The rich don't hold money. They hold assets. This is the core point. The middle class and the poor typically hold most of their value in cash, savings, fixed income. The rich hold their value in stocks, businesses, real estate, investment funds. When interest rates fall close to zero, money becomes cheap. When money is cheap, assets become expensive. After 2020, the wealth of global billionaires increased dramatically, while millions lost their jobs. That's no coincidence. It's a mathematical consequence of liquidity. 5. Inflation. The price of relief printing money isn't free. It translates into inflation. Following the intense post-COVID stimulus period, many economies are facing their highest inflation rates in decades. Inflation is like an invisible tax. It doesn't tax rapidly appreciating assets. It taxes everyday purchasing power. The ones who pay the most are those living on wages. 6. The system wasn't designed to be fair. It was designed to be stable. This is the philosophical part. The modern financial system wasn't built to guarantee absolute fairness. It was built to maintain liquidity, maintain confidence, prevent chain collapse. And when faced with a choice between Saving the financial structure or saving the balance of assets, the system always chooses the structure. Because if the financial core collapses, everything else collapses with it. But when that core is saved, asset prices rise first, and whoever owns the assets benefits first. 7. The issue isn't anger, it's position. Crisis doesn't magically make the rich richer, but how we react to the crisis makes it happen. Printing money doesn't save everyone. It saves the things closest to money. The important question isn't, is this fair? But, where do I stand in that flow? If you stand outside the asset market, you perceive the crisis as a shock. If you stand within the asset market, the crisis can become an opportunity. The end. Slow, somber voice. The history of 2008 showed that. 2020 repeated it. And the cycle will continue. Crisis doesn't disappear. But understanding its mechanisms helps us avoid being caught off guard. In a world where money can be made with a click, true value doesn't lie in money. It lies in your position, in the flow of money.